I just think you need, for your long-term assets, you need to know why you own it and have conviction in it.
Well, that's what I'm saying. So because, for example, owning growth in 2021, if I was talking to you in the middle of 2022 when it was getting ripped, you wouldn't have felt like that was a good decision. But if you had the staying power to stay invested, actually, here we are 3 years later, growth is still done really, really well relatively. Welcome to the Money Alchemist podcast. I'm your host, Brett Gargano.
And I'm Ben Jones.
And we thought, I sometimes feel like as investment advisors, we're kind of beating this dead horse of like, stay invested, just stay invested. There's nothing to do, just keep at it. And I think there's some truth to that. We've talked about it a lot on this podcast, but like there's no question that both you and I were hearing nervousness from people, right? I mean, headlines, I don't care what your political party is one way or another. I mean, it feels like the heat of the news, maybe the media outlets have kind of turned up the heat a little bit. So we thought this was a good opportunity to, kind of revisit some of the ways that we think about investing from the perspective of an advisor, how you should be thinking about investing, and just give you some of our thoughts. So, Ben, what have you heard recently?
Well, a lot of it has to do with people calling in, and the people that are calling in are the ones that are paying closest attention to CNBC, Fox Business, whatever media outlet du jour that they prefer. And there seems to be hyperbole, as always is. Sensation sells, right? If it bleeds, it leads. So, a lot of folks are panicking because of major swings and very volatile assets. We just, before the show started, we're looking at the price of Bitcoin. It's gone from 105,000 and now it's sitting at 87,000. That's a massive swing. That's that's definitely over correction territory. Approaching bear market territory, which I predicted, by the way, in my 2025 predictions, was that crypto
better lucky than smart sometimes, right?
Exactly. That's exactly right. But yeah, so and then you also have Palantir, which has been a high flying stock. It's been everybody's darling for a while. It's involved. I still don't understand what they do, but it's involved in AI. But the stock went up a crazy amount. It was like up 70% year to date or something crazy.
400% roughly over a year long period.
Crazy performance, but it has pulled back very aggressively. The CEO and co-founder announced that they're going to be unwinding billions of dollars worth of position in it. And everybody panicked. And of course, NVIDIA has pulled back. So a lot of these, very high beta names are pulling back. At the same time, we're getting hit with headlines about tariffs, about government cuts, which I do want to address, Doge briefly, because that's been, in my opinion, a lot of noise. And you have opinions on that I find are very interesting. But everybody's consuming this information. So their reaction is, I have to call my money guy and I have to place trades. Something needs to be done. Action needs to be taken, because if I don't take action and I'm complacent, that's going to hurt my financial results.
Well, and I think that voice, I don't want to come across in this podcast like we discourage that. I've had several folks that have reached out and asked about whether we should be getting more defensive, or what changes that we should be making in light of, some of the, I'll say, perceived increased volatility, because, it feels like volatility is new. I mean, we always feel like volatility is kind of new, but we quickly forget just how volatile, markets are on just a regular basis. Anyway, but I think that when you find yourself asking those questions, it's important to delineate the emotional response versus the logical response. But investing is an emotional game. And we've said it on this podcast that, the best investment is the one that you can stay invested in.
Yeah.
Right. And so you do want to listen to that voice a little bit, because if that voice is nagging at you, like if you think it's nagging at you now, wait until it really gets.
Yeah. Wait till we actually have a bear market.
Right. I mean, it will feel a lot more painful, and you don't want to be the person that capitulates right at the bottom.
Yep.
Because, you've kind of discouraged yourself from, showing some of those emotions. So I think as a planner, it's really important to help clients take a step back and maybe think about what the impact of short-term volatility is on their financial plan, which, by the way, can be good in some cases, can be bad in some cases. It's not a one-size-fits-all thing. And then also think about, I do believe there are some practical steps that we can take in light of some of the observations that you can make around the market right now. So like without being reactive, like what are some things that we can start talking about doing?
Well, I think it all starts with your needs. So before you determine, should I place a trade here or place a trade there, portfolio management should always be determined after you've determined your financial plan. And what I mean by financial plan is how much of your capital are you going to need over the next 2 to 3 years, 3 to 4 years, so forth and so on. Because volatility affects people differently. Someone like my kids, I have UTMA accounts set up for them, and we invest in silly things like Roblox, and and some not silly things like Microsoft. They don't care. They're not paying attention to the ups and downs and the swings in the market. It doesn't affect them one iota because most of the time, they don't even remember that the money exists. We do talk about it, but for them, it's so far out that they're going to even need that money that they don't even think about it. Now, compare that to someone who is close to retirement and they need that money. The volatility is very salient. It affects them both, financially speaking, but more than that, emotionally.
Well, and I think it's so, the concept that you're talking about there is something that in the industry we talk about as bucketing, right? It's creating kind of different buckets for different money. And I think that can be really important because, again, investing is emotional. And so the more we can do to kind of create a logical framework to help us kind of sell ourselves this emotional process. But I think, so many times in my career has somebody reached out and said, but I'm going to retire. I don't have any time, I don't have any time to recover. And, we kind of forget that, people can live a long time, and you need some of that. Like, let's say you're retiring tomorrow. Sure, you need some of this money over the next 1 to 5 years, but some of this money you might not be using for 25 or 35 years. And so I think one of the things that you want to do is, it's in our industry, it's kind of called giving every dollar a job, but kind of recognizing like, what is this bucket of money used for versus that bucket of money? And then making sure that if you need the money sooner, or you're using that money sooner, that you have a more defensive play for those dollars. So you don't have to lose sleep at night with market volatility. Inevitably, markets are going to be volatile.
Yeah.
So
I really like the concept of bucketing because I like keep it simple, stupid methodology. And it just works. It's easy to conceptualize. It's easy to implement. So someone who is about to retire, now this isn't always true, but someone who's about to retire generally has a larger, near-term bucket than someone who is young in their 20s and looking to just, invest aggressively. And the reason is because if you're about to retire, you're going to need to replace your income. And if you're lucky, you're going to have a large percentage of that replaced by Social Security or pensions. But generally, that's not the case. Generally, you're only replacing about a third of your income that way. Sometimes less, oftentimes less, especially if you're a high income earner. It only may be like a 10% replacement. So you're going to need a good chunk of cash reserved for the next several years of your retirement. So here's the question on everybody's mind right now, Brent. Markets are super volatile. The Buffett indicator, all-time high. higher than it's been in the .com bubble, which the implication being, things are about to drop, the shoe's about to fall. So what should I do? And what's your response to someone who has that concern and that's about to retire?
Well, I again, back to this idea of bucketing, giving every dollar a job. I think it's important to take a step back and revisit the financial plan and make sure that we've talked about this in past episodes, but make sure that the planned spending is aligned with the actual spending. And, you're not going to, it's kind of hard to think about planned spending 20 years from now, but it's much easier to think about planned spending over the next handful of years. So you really want to make sure you've got an idea of what are the variables. Like, is this person expecting to sell a home over the next couple of years? Are they going to receive an inheritance? Or, what over the next couple of years is going to change, and how is that money going to fund their expenses? And a lot of people, again, back to this bucketing approach, they kind of look at the statistics of investing. So I went ahead and I pulled up the stock market performance over different rolling periods of time historically. So if you look at any 5-year, 10-year, 15 or 20-year period of the time in the stock market, like, what are your chances of being up? And this is according to a Y Charts blog article, but over a 5-year period of time, your chances of making money in stocks since 1955, 81%. Over 10 years, 92%. And over any 15 or 20-year period since 1965 or 1970, you actually have a 100% probability of being up over 20 years. So a lot of times as advisors, what you try to get a sense for from a client is like, how comfortable are they with risk? Because their comfort is going to drive, it's hard to, somebody loses money and they get scared and sell out of things. That's not going to help anybody. And so you want to be aware of that. And then you want to make sure that you're realistically looking at their needs and setting aside, I think the typical rule of thumb is a year to 2 years worth of expenses in cash or short-term cash equivalents.
Things that don't go bump in the night.
Right. So if with certainty, you are not willing to be flexible on when you spend this money, you're going to spend, X amount of dollars on X planned spending in the next 2 years. Keep that in your savings account.
I like to use 3 years, and I base that off of the great financial crisis. It took about 3 years to reach back to break-even points. Now, the past couple bear markets we've had, it's taken less than that. In fact, in 2020, we had a bear market, and then by the end of the year, we were back up 20%. Now, we had the next bear market, which was just actually 1 year later, from 2021 to all the way to the end of 2022. It lasted about a year and a half. And that was actually more. It was less. I think the 2020 or 2021 down bear market was down like 30%, and then the next one was down about 22%. But the second bear market, because it took 18 months, it was like death by 1,000 cuts. That was more painful for a lot of my clients. A lot of my clients they didn't capitulate, but they definitely called in more often. They were more concerned. But anyway, back to what
statistics say that it takes 2.5 years to capitulate.
Yeah.
The average human can sell themselves something for 2.5 years before it essentially
I find that to be true.
Ask questions.
Yeah. I think that when it comes to investing, so it's interesting that the S&P 500 stat you get, the only one that was guaranteed. No, there's no guarantees. I mean, the only one that 100% of the time made money was the 15-year average.
Well, and that's since 1965. So, I mean,
that's why I think when people tell me, oh, I should just buy the S&P and go away, it's like, well, it's not that simple, because not everybody I talk to, actually most people I talk to, don't have the resilience. They don't have the temperament to stay invested for that period of time.
Yeah, it's easy to look backwards and talk about 5 years like it didn't last
Correct.
A long time. But the people that I talk to that lived through a lot of these downturns, I mean, you as an advisor going through 2008, it's easy to talk about now, but I mean, you're talking about what, two plus years of just getting beaten up.
Most people can't do that unless you're just not paying attention. There are some people out there that they invest and they just completely forget, and they get so caught up in their life. But the vast majority of people, they're very in tune with their wealth. shouldn't say very, they are somewhat in tune with their wealth, and they at least check in on it.
It's important to them.
Yes. And it should be. So they don't have the temperament to stay invested in something like that. So you need to have something that's a little bit more consistent. And I find that most investors, even the younger ones, even the so-called aggressive investors, they need to see some results over 3-year averages. There needs to be a positive result, or else they start losing conviction.
And I think what's so hard is like that, and that's why it's so important that we kind of do, back to the beginning, beat this topic over the head a little bit, because, as much as people are like, okay, Brent, I get it. You've talked to me about long-term investing 20 times. If I don't talk about it a whole lot now, then when the market is down and I'm talking about it then, it just makes it harder to, kind of remind yourself and live back in that logic side of your brain that says, oh yeah, you're right. I shouldn't sell my portfolio when things are down 30%. But back to your question of what do I do? So I wrote my newsletter over the weekend about long-term investing and what have you. So we have some stats on this. A lot of advisors talk to this stat of doing, not staying invested through market volatility. And they use the idea of looking at periods of time where if you were invested fully versus not invested during the worst 5, 10, 15, 20 best days of the market, how much of your return would have lost. And I think this is a really important stat, because I'm not trying to say, again, at the end of this, we do have some thoughts on things that you should consider looking at, within your actual allocation and related to your plan. But, just trying to think about this generically, there are a lot of statistics that say you should do nothing. So I looked at the growth of $100,000 and I picked a pretty terrible time frame. Okay, so the growth of $100,000 starting in 2000, January 1 of 2000. So, anybody that's been invested or is going to realize that was the beginning of the dot-com bubble.
Yes.
Right. And then it was the top. And then 7 years later, we had another top. People forget because, we've had such a really good 10 years of the market. If you look at their last 25 years, we had one of the worst investment decades from 2000 to 2010.
Yep. It was the lost decade.
And so anyway, the point of saying that is I am not cherry picking this to show good data. I could show a much better number than this. But if you had $100,000 invested in the S&P starting in 2000 and ending at the end of 2024, December 31st, that 100K today, or December 31st, would be worth almost $640,000. It's an annualized rate of return of almost 8%. If you missed the best 10 days, $292,000, 4% return, right? You basically have done bond-like returns on that. And guess what? People are so quick to say, but Brent, if I'm invested during, good times and not during bad times, we'll get those best days. Well, no, that's not how it works. These best days, they come during the worst periods of time. So I'm looking at the list right now of the 40 worst or the 40 best market days over that same time period. The 2008, 2020, 2009, 2002, 2001, those years are littered on this thing. The hardest times. I mean, I remember coming to work during COVID and the stock market was down 10% pre-market.
Yeah.
We were like triggering, market
stop losses,
stops. And you would have thought, I mean, any given day, you could come in and the stock market would be up 10, down 10, whatever it is. And so I think it's really hard though. I mean, it's like while those times feel like the most important time to do something, they're actually the something that you should do at that point is kind of stay put.
Yeah. And I have a few comments about that. So, this is why it is critical that you need to know what your withdrawal demands on your portfolio are going to be, because you do not want to be caught up in the jaws of secrets of return risk. What that means is that, let's say you have I use retirement because it's the largest financial goal most people have, but it could be any goal. Let's say you have a large distribution need from your portfolio and then you wait, the market falls 30, 40%, and now you have to trigger that goal. You have to withdraw from a depressed asset. that's an issue.
You don't, the easy term that I kind of used to think about is you don't want to be a forced seller.
Yeah.
Right.
So what you do to mitigate that, this is what I like to do. Now, there's a lot of strategies around this, but this is the simplest strategy that I know that people understand, and it's easy to implement. Just don't put like whatever you need from your portfolio in 3 years, which requires planning. It requires planning to know what your spending need is going to be over the next 3 years. Whatever that is, put that in something that has a low correlation to volatile markets, that has low volatility, and ideally you want a high positive real return. But we're running into realistically, there's only so much return you can get in a riskless asset or a risk-free. There's no such thing as a risk-free asset, but a asset with a low degree of volatility. So, things like T-bills, short-term CDs.
Just a high yield savings account, I think, is such a critical
savings
tool.
account, which is cash and cash equivalents. So 3 years, lock that in. Now, that's different for everybody. Let's say you're buying a house cash. That's very difficult to do these days, but let's say that's hypothetically the situation you're dealing with. Then, and you're targeting a $500,000 purchase. Well, you need to have $500,000 in something very boring,
or be an asset that you're going to sell to fund it, right? And
but that's the problem: is the asset. It can't be the SPY. It can't be something.
But it could be a house, right? I think a lot of people buying houses are also selling houses.
Well,
so it's the point is you want to look at, and that's kind of why I mentioned earlier, looking at things like the inflows that are expected along the way, and also thinking about how those inflows are related to the stock market. So, like, for example, maybe you're expecting an inheritance. You're retired, your parents are aging, you're expecting an inheritance. Now, it's always the awkward elephant in the room of, do I plan on my inheritance? And I would say when your parents are 65, no. When your parents are 95, it becomes a bit of a different story. But let's say that inheritance is life insurance. There's no stock market component to the life insurance, right? That's very different than if your inheritance is expected in the form of a stock portfolio.
Yeah. You really don't know like when you're going to get a windfall, from something like an inheritance or even a business sale. But generally speaking, you need to have a good idea of what your cash outflow need is going to be. An approximation. It doesn't need to be scientifically to the penny. Now, once you have that figured out, the rest of your asset allocation becomes much simpler. You need to, I say that you only have to have two things for your long-term capital to grow. That is, the assets that you buy need to be natively scarce, and they need to offer social utility. If your assets have those two things, generally over time, 5, 10, years or longer, these assets are going to appreciate so long as we live in a fiat standard. Theoretically, how many dollars can exist?
Well, I think your point is when you turn the printing press on, there's a whole lot more dollars in the system. And, Apple shares is always the example that we kind of use of this. But just because the government creates more dollars doesn't mean Apple creates more Apple shares. Right now, in goods, you have other things that, like, you have efficiencies. Yeah. Right. Companies can get better at making something. Cars are a good example of this, right? You look at how the cost of a car, or TVs are a great example. Look at how much cheaper and more affordable TVs have gotten over the last 20 years. Those are examples of places where technology impacts the price of goods. But if you look at shares of Apple, the price of real estate, the price of land, like things that have true scarcity relative to the dollars that get printed, those kinds of things.
Yeah. So what I'm trying to do here is I'm trying to lay the foundation for investment conviction. So you've got your, we'll call it bucket 3, long-term capital. This is money that you're not going to be spending for 3+ years. I think this is where people capitulate and they make mistakes. They fail to keep their long-term vision because of weak points in the market. But never forget that we are in a fiat standard and there's virtually no limit to the amount of dollars that can be printed. None. And when you pull your money out of financial assets, good financial assets, and when I say good financial assets, I'm thinking things that are natively scarce with social utility. And I'll define those two concepts here in a minute. But when you pull money from that and you park it into fiat currency is like as cash, money markets, that's bonds. You are essentially saying, you know what I value more? I trust the dollar more to be a store of my wealth more than something that has the potential for appreciation, that has a finite limit to it. And I think that's a very short-sighted view. Yes, you might comfort yourself by not feeling, the acute pain of volatility, because volatility is very painful for most people psychologically, because there's very few things that feel as unpleasant as taking a chunk of money, putting it in something and watching it become half the chunk. I don't care who you are. That is painful to do. So we avoid that at the cost of long-term appreciation. So the truth about volatility is it's a sword that cuts both ways. And most often it cuts the positive way. That's why we're talking about the S&P 500 and its 15-year positive. And I don't know if you can pull this up in Y charts quickly, but what is the difference between over the past 30 years in investment in U.S. Treasuries, something like TLT versus SPY?
Long-term treasuries?
Yes.
Give me just a second.
Or you could do maybe not long-term treasuries. You could do like just T-bills. But while you look that up, I'm going to continue to define what I mean.
How long did you want me to go back?
20 years. Just do 20 years. But I also want to take a step back here and explain what I mean by natively scarce with social utility. Natively scarce means scarcity is built in to the nature of the asset. Real estate's easy to conceptualize here, because how much can you create more land, Brent? Well, I guess if you're in Saudi Arabia, you can just pour
you could be in the
into the
metaverse.
ocean. But the
metaverse.
Whatever. Metaverse. Nobody does that. But the point is, no, you can't, unless we can figure out like dimensional gateways. So you can't create more land. So it's natively scarce. The next thing is, does it have social utility? Does land have social utility? Well, of course it does. It has social utility because that's where we live. That's where we build houses. Now, there are certain lands like Antarctica, not much social utility there. Swamplands, not much social utility. So it's not all land is valuable. Only certain kinds of land is. So you need to have both criteria lined up in order for it to be an appreciating asset relative to fiat currency. You can apply the same principle to things like, gold. You can apply it to things like Bitcoin. You can apply it to things like stocks. The stock market's been around for a long time, per historical record since 1610. I think that's when the East India Company was founded. Correct me if I'm wrong. I know it was the 1600s. But, there's a disincentive to issue secondary shares, because let's say I issue 1,000 shares of, Jones Company, and then I say, well, I'm going to issue another 1,000 shares. What does that do to the original 1,000 shares out there? Well, it dilutes them. So you hurt your shareholders, which are usually impact, the boards of directors and the CEO and the founder quite detrimentally. So now I'm not saying companies don't do this, but there's a natural disincentive to do it, to raise capital that way. So shares of stock do have a natural scarcity built in, and the social utility, it's a bit more complex than real estate, but it's a way to disseminate ownership of corporations. These corporations are so large, you can't just have like one or two owners. You need to have a lot of capital combined to create this enterprise, or to provide a financial foundation for these things. And it also is a way to disseminate revenues and to divest your shares. So you've got it's a very important financial technology out there, and the social utility is immense. So stocks fit the bill. So once you wrap your understanding of what creates a good long-term investment and what does not around that two, native scarcity, social utility, then it's easy to firm up your conviction in it.
Well, and I managed to pull up what you asked for.
Sure.
So I've got the S&P 500, the SPY total return since 2000. I'm using the same time frame as before, 2000 to end of 2024, so 25 years, versus the Bloomberg Global Aggregate Bond Index. And so if I told you the annualized value in bonds, you've made an average of 3.2% per year. In stocks, you've made an average of 7.65. We talked about it earlier, a little bit under 8% per year, right? So doesn't sound like a whole lot, right?
But
like
4% a year compounded over 20 years.
So it ends up being the growth of $100,000 in stocks. Like I said, it's 600 and some $1,000. Within bonds, you're only up 120%. So $100,000 has grown to $200,000. And by the way, the purchasing power of your dollar, like that sounds good. At first, you're like, oh, I doubled my money over 25 years. That's not terrible. Well, if I also showed you a chart of the purchasing power of your dollar over that same 25 years, I recently gave my last lecture for my college class was on investing. And one of the first slides in my investing presentation is on the purchasing power of the US dollar. And I always show it since 2000. I guess my students roughly are early 20s. So I kind of show them early 2000s to now, the purchasing power of a dollar over their lifetime. And it just, it's like the dollar's lost 60 to 70% of its purchasing power over that same time. So if you didn't double your money, I mean, I would be willing to bet that 120% is still, if I pulled that up and compared that just to inflation, you're just keeping up.
Yeah, that's exactly right. Weak hands can cost you your future. You need to maintain a long-term conviction in your retirement portfolio. Who was it that Nick Murray was asked a question in 2020 during the COVID crisis? They said, what should investors be looking at to basically take advantage? I forget the exact wording of the question. To take advantage to react to COVID, and his response is as they shouldn't. The point of what investors should do is pick a sensible asset allocation and stick with it. Not to try to monkey around with it. And I think that it's very important to line up your long-term portfolio with your temperament. Because the moment you capitulate, as you said, is the moment you potentially blow up your financial plan. You could get lucky. You could sell at the peak and buy at the bottom. But how many clients have you seen that been able to do that successfully?
It is absolutely brutal to actually do it. Everybody gets excited when the market's doing well and peeved when the market's doing poorly. Yeah. So, and I think right now we're starting to see that, one of the things that we do a lot of preaching, don't time markets. And, I don't want to come across like talking out of the sides of both our mouths, but there are certain things that we want to look at as advisors that give us an idea for, what might happen. And one of those things that's really showing up right now is this just massive underperformance by value stocks relative to growth stocks.
Yes.
I mean, if you have owned the S&P the past 3 years, you are doing very well compared to a diversified portfolio. Because guess what? A diversified portfolio doesn't just own U.S. large cap companies. It owns small and mid caps, some international, some emerging markets, right? And if you look right now, if you were to pull all of these things up, the dominance of large cap growth is huge. So like your Apples,
it's like 3x.
So I think it's important right now. I mean, we've talked about this in a past podcast, and it's not gotten better. As a matter of fact, it's gotten worse. And that's the hardest thing about this is it's not easy to call tops. It's not easy to call bottoms. Like momentum begets momentum. But before this podcast, we pulled up a chart of the Vanguard Growth ETF versus the Vanguard Value ETF. And if you look at it over 10, 20 years, there's no question that growth stocks have done really, really well compared to value stocks. And so does that mean that growth stocks are going to, I don't know. I mean, last time it was like this, the last time they were as wide as they are right now was right before 2022. And in 2022, growth stocks sold off almost 50%.
Yeah.
When value stocks held up. So I do think, back to a point we made earlier, if you are feeling a little bit of anxiety right now, right? We talk about financial stress versus financial anxiety on a previous episode. Financial anxiety is, your financial plan hopefully you have a financial plan, and it should work through a variety of market conditions. And really the main thing you're having to manage here is just your emotional resilience through those market conditions. But if you are feeling a sense of anxiety right now, like that voice should tell you something. And it doesn't mean that we should jump ship and totally change things, but we should have a serious conversation about, what does your financial plan look like? What does your concentration risk look like? How do we contextualize your performance versus S&P performance within the framework of like the S&P? Because remember, the S&P index changes based on the size of these companies. The S&P has gotten pretty growth heavy, and it's gotten pretty weighted to these top, top companies in it.
It's concentrated.
So
trying to get at.
Eventually you would, that's going to likely have some level of closing the gap, whether that's outperformance from value, underperformance from growth. But,
I don't really like the term growth versus value and all this. And I don't want to get into the merits of asset allocation and diversification right now, because that is an open argument. That's a good topic for another episode. Is it, because Charlie Munger, he railed against diversification. He thought it was pointless. He when he passed away, he had 4 assets. He had Berkshire stock, Costco stock, some rental apartments, and a China fund. That's all he had. And he said his words were, if you have a gold mine in your backyard, why would you invest in every square foot of your backyard? Why not just put everything in the gold mine? So he firmly believed in concentration. Now, again, that's a topic for, I don't want to get off on that, but we talked about, you were mentioning, growth versus value versus this versus that. I just think you need, for your long-term assets, you need to know why you own it and have conviction in it.
Well, that's what I'm saying. So, because, for example, owning growth in 2021, if I was talking to you in the middle of 2022 when it was getting ripped, you wouldn't have felt like that was a good decision. But if you had the staying power to stay invested, actually, here we are 3 years later, growth has still done really, really well relatively. So was it bad that it was down 40, 50% in 2022? It's hard to put that. It's hard to explain that for somebody's personal situation, because if they stayed invested through it, if you own, S&P 500 and you want to stay invested in the S&P 500 and you're okay with that concentration, I'm not saying that's a bad thing. I'm just saying be aware of it and what that means for what you have to go through, because that concentration statistically increases volatility.
Yeah, you're right on point with that. It's good information to set expectations.
Right. I'm not saying that you should or shouldn't do it, but you should have an awareness, because it sets you up for success over the long haul.
Yeah.
What wouldn't have helped is if, when growth was down 50% in 2022, you decided, you know what, you're right, I shouldn't be in this growth stuff. The S&P was concentrated, whatever it is. So you jump ship, you buy the other stuff, and then you never saw the rebound like you would have gotten the growth, right? And that's really, that's what we're trying to help you avoid.
Have you seen any of the market forecasts? I've seen several of these. I haven't looked at the JP Morgan capital market assumptions, but they're only forecasting, some of these models are only forecasting like 3 to 4% annual return on the S&P over the next decade. pretty abysmal. But these things you take with
we
the
saw
grain
those
of salt.
10 years ago. I mean, Vanguard used to say 10 years ago that we've had great returns. So these and it's not wrong. It's just trying to predict how that lumpiness is going to work out is really tough.
It is really tough. And that's why it is important to have conviction. I know I keep pounding this point, but you need to have conviction in your asset allocation to maintain the proper investment behavior. And I narrow it down to those 2 points with every one of my clients to say, this is why we own these things. And you can apply that model to growth stocks, to cryptocurrency, to commodities, I'm not a big commodities investor. I more like the precious metals, but you can apply these things. Now I don't think you should pile all your money in one thing. I still believe that diversification has a lot of benefits, and you don't want to pile your money in just one thing and concentrate risk. Now you can. It's created a lot of really wealthy people, like Jeff Bezos, for example, put all his capital in Amazon. but then he had direct control over that, So there are exceptions to everything. But I think that you can be also on the other side of the spectrum, over diversified, where it can hurt returns.
Well, I the way I look at it, and we can wrap this up, but the way that I look at it is you have a spectrum. On one end of the spectrum, there is getting rich.
Yeah.
On the other end of the spectrum, there is building wealth. And while both of those things have similar characteristics, e.g. a big pile of money in the bank, getting rich has... There's kind of a couple of things inputs that you want for getting rich.
Yeah.
Concentration is one of them, and luck is another one. And I think that, while I would agree that Bezos has control, and I'm not trying to take anything away from some of these wealthy people, there is an element of, and whether you call it luck or you call it kind of persistence and being in the right situation. But, if you put all of your portfolio in Apple stock 40 years ago, clearly you would be rich today. Now, building wealth, it's not so luck oriented, right? If you invest in a group, in a collection of natively scarce assets, there are some very strong statistics that will show that over time you will be wealthy. Now, are you going to be as wealthy as somebody that concentrates and gets really lucky? No. The range of outcomes are a little more tame, right? Yeah. But your consistency, the probability that you're going to get there, much higher, right? And I think that we can end on this because this is another topic for another podcast. But one of the skills that many of our wealthy clients have learned is like how to manage diversification and manage risk with the financial capital they've saved, but be smart about kind of where they place their concentrations and kind of how they I'll say, quote, make their bets in certain places. And those bets can make a lot of wealth. And then those diversified portfolios can really store a lot of that wealth.
Well, that's a good way to end it, Brent. Appreciate everybody tuning in for this long. And we look forward to catching you in the next episode.
Yeah, we'll leave. I'll leave my newsletter in the show notes, as well as some of these images that we talked through. And thanks, Ben, for taking the time.
Yeah, I appreciate you, Brent. Determine which strategies or investments may be suitable for you. Consult the appropriate qualified professional prior to making a decision. Any company names noted herein are for educational purposes only and not an indication of trading intent or a solicitation of their products or services. Advisors associated with National Wealth Management Group may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA, SIPC, and investment advisor representatives of National Wealth Management Group. Or 2, solely investment advisor representatives of National Wealth Management Group and not affiliated with LPL Financial. Investment advice offered through National Wealth Management Group, a registered investment advisor and separate entity from LPL Financial.